The issues that investors face is unchanged. They've always had the same dynamic between do I chase yield and do I take risk and where's my trade-off. What's changed is that the relatively risk-free rate that you can get from just putting your money with a bank and sending deposits has now got to levels which many investors find unacceptable. So there's a simple choice there really. There's no special solution or there's no magic bullet that we can provide. At the end of the day, if you want to take a little bit more risk, you can get a little bit more return hopefully, but you can't solve for that equation and find a magic way to still get 4 or 5% return. The only way you can do that is to take on additional risk. And there's two main ways that you can do that. You can either go into the equity market and take your dividend yields from companies that are paying those higher rates of dividend and hope for some capital gain, and that comes with the risk that you might get a capital loss. Or you can invest in bonds that are trying to yield a little bit more, but even then, even if you're going down to the BBB bonds, you still might only be getting 2 or 3% at most. And so the yields that we're seeing in corporate bond funds are coming right down as well. There's no hiding from that. Diversification is the free lunch in investing. It's been said many times, and it's said for very good reason, is that a good, well-diversified portfolio is definitely better than trying to put all your eggs in one basket. And that's what we've been trying to do with our income fund, is to create a portfolio for investors, which is giving them some exposure to some equities that are providing a slightly higher yield. We're taking on some risk within the bond markets, and there's going to be a portion in the lower yielding securities as well. You wrap that all together and you're trying to provide a stable income for people over time, and you're accepting that for doing that you're going to take on some of those additional risks. We know the dynamic with the New Zealand dollar is that typically when risk is off, that is when markets are falling and things going pear-shaped or negative, we know that people retreat to the safe haven currencies. So we see the US dollar appreciating, the yen appreciating. We saw that back in March. Risk's now back on, people are happy putting their money into the riskier assets, and so then we see the New Zealand dollar sort of rallying into that. So that's not an entirely unexpected or unusual turn of events. In addition to that, when we see the amount of stimulus that central banks are putting into supporting this recovery, and we're talking about trillions of dollars of credit being made available through the Federal Reserve, we're seeing the central bank in Europe come to the party. With that amount of stimulus, we're almost inevitably going to see the US dollar weaken into that environment, which conversely means that the New Zealand dollar strengthens slightly. So it will be slightly harder for our exporters, but we're still operating within a modest range, and it's nothing to be overly concerned about. There hasn't been anything this season that we weren't particularly expecting. We might have anticipated that a capital raise from New Zealand might have been announced at some point, which it hasn't yet. I think that's probably still on the cards. But other than that, the reports have largely come in line with what we were expecting to hear. And you're exactly right. There are winners and losers through something like COVID, and then the New Zealand market, generally speaking, is tilted towards those that have been okay. So we look at the likes of A2 Milk and Spark and those sorts of companies that have still got good strong demand for their goods and are able to operate. The real pain is probably going to be felt in the smaller the SMEs, the one-man bands, those that haven't got access to capital markets. It's going to be a lot more difficult for those sorts of companies to respond, to grow, and to be able to adapt into a post-COVID world. New Zealanders bringing skills that they've learned offshore back to New Zealand is fantastic. So I think it's really good for the New Zealand market. But it's not a new dynamic. People have been doing it for a long time. The bit that I'm not sure about from the data, I didn't look into the detail, is we know that Kiwis have always been coming back into New Zealand. Are they coming back in bigger numbers? Or is it just that we're not seeing people head off overseas? Because the flip side of this is if New Zealanders don't head off and do their OE, and they're not going to New York and London and Chicago and Singapore and Hong Kong, etc., then when's the next generation going to be picking up those global skills? Is New Zealand just going to become a more insular hermit kingdom, or is it still going to be sending people out into the world, learning those skills and bringing them back? So we might be getting there might be a one-hit wonder now with some people coming back, but what does it mean for the next generation?